What's up, guys? So for this video, I'd like to ask you guys to like, comment, and subscribe. So today we're going to be talking about the stock market. It's not 1 month of update since our last time, but we are at a point where I have been able to recover all the money that I have lost in the past couple months, or pretty much almost a year. But I did start at like 14, like 15,000 over here in the beginning, almost 15,000. I did cash out a little bit, and then we went up to like 22 is only 23. It's a little bit more than that. I don't know why it doesn't show the whole amount, but I remember seeing it better. And then we did go like a $7,000 loss, and we've been recovering since then. And since we went down under our account around June 10th, 2022, and it's been literally a little more than a year till we are back to recovery. Now I am up $45, which is pretty good. I am using a new strategy, so that's why I want to share. This strategy I've been using for like 2 weeks now, so I haven't had a failure yet, but this is what the strategy is. It's called credit spreads. So credit spreads means that you buy and sell a call or a put. So you have to buy and sell both. You buy them you sell a put at a lower price or a higher price, and you buy a put at a higher price. I'll show it in detail right here. I'll show it on SPY because I do have this put open right now, which I'm trying to get rid of at 1 cent because you have to get rid of it at 1 cent. So let's go to SPY and we'll go to the options. So right now SPY is at 438, which means that our put spread is doing pretty good. So here we go. This is what we would do. So we would go and we would sell a call. For example, we're going on the call and we don't want to do 0 DT. So we want to do, realistically, it'll be good to do 30 days out. So this is something that you can do. And this is still open today, so it's possible to do it. It is only 12:36 p.m. I might upload this as soon as possible. So I like to go to something that's less risky. So I would go to something that is like over here a 90% chance. So I would consider taking this, and then I would sell a call at the 44 strike, which would be a $16 gain in about 30 days, which is a pretty good gain in the sense, but also is very cheap because it only costs for one of these contracts, it only costs $100 or yeah, it only costs $100 to enter this trade, and you're at a $17 profit. But the problem with this trade is if the stock goes up to the price of 456, then you are at a chance of losing all your money you're putting in. So if you put $100, you make 17. Right now, I'm trying to use 10% of my portfolio, so I would make 15 contracts, and I would get paid $255 for this contract, which is nice. It's a good amount of money, but I am at risk of losing um $1,500 out of this, which is not fun to do. But you could do the same thing on the other end. You could sell a put, and you would sell a put. Let me close this out. Okay, so sell a put. We would do the same exact thing. We would go 28 days out. I want to take something that's less risky. Even like our when we sold the call, we sold it like 56, right? I think that is yeah, we're at a 10 delta. I like to look at the deltas because the 10 delta is pretty much a really low risk of this happening. You also look at kind of the theta in this situation and also the interest. There is actually pretty good interest on here. The separation is only like about $1. So this would be a good contract to go with because you can get filled quickly. You don't have a big spread because when you have a big spread, like a $10 spread, you're technically losing those $10, which sucks, but it does happen. So on the other end, we would sell a put. It's the same exact strategy. You can play both ways of the market. You just pretty much have to make sure the price doesn't hit your target price. So even here, we would go for a 90% win because 90% win rate because we want to hit a 10 delta. So pretty much anything that's 90% win rate is a 9 delta. So even here we would sell this put here and we would buy this put here. It would only be a $4 profit, but the separation between 438 and this 414 is what we are looking for because it's a pretty big separation right here. We could say it's like a $14 separation, right? 24 plus 1, 24 plus 8. It's a bigger separation. we could actually like just use a calculator to calculate that really quickly. Separation is pretty decent, and you are getting $4 per contract, which is pretty much your max loss here. You're getting $5 actually on this contract, but your max loss here is $95, and your break-even price is for $13.95, which you don't want it to get that low. You would typically just want this to get as close to like 415, and I haven't been at a loss of these contracts yet, so right now I haven't had to sell for a loss, but I know eventually I will because I will be doing these contracts more often. But I am trying to do 1 month out or the third week of every month, because the third week of every month is the most sought after contracts and has the most people trying to buy in. So we're gonna do our 438 minus the 414 because we can't get it to, if it hits 414 we would lose that. Whoops. 414, and that would equal $24. So we have a 24-hour difference. SPY would have to move down $24, so we lose that position. The same way in the other side, where we would sell our call, right? Where we would sell our call, we said we would do a 90%, which 90% right now is right here. And we would do this, and then buy one here, and we would get a $16 gain here, which is a better gain, but I think it's more risky because SPY is going up right now. I think it's slightly more risky because of that point, but nonetheless, this is a separation 456. Let's do in the sense 450, 456 minus 438. I did 5. Uh, okay, I did that completely wrong. 456, right? Yes, 456 minus 430. Oh, come on. Minus 438 equals 18. So separation is 18 there. That's why we're getting more money out of this contract. But even then, even if we were to say try to go for dollar wise, we could go for a different contract even here. We could go for something like a 460. Or actually, this is $200 separation. Let's see. Wait, we would sell call here, buy call here, and separation would be $11. But technically, that's $200 you have to spend for that contract. So it's like $5 per contract, which is not bad actually. Because it also gives us a 5. That also gives us here a 7 delta, which is very low risk, and the possibility even goes higher because even here we had like an 18 separation. This is like a 20 separation, right? Because we're at 58. It's a $20 separation, and we're still getting $12 from this, but we're spending 200. So in my case, I would do, instead of doing 14 contracts, I would do 7. It's the same. It's the same price of 14,000, and I would get paid 91. That's pretty much the strategy I've been using recently, and I'm very happy about it because I have been making some money. But like I said, I am very happy about my account so far. Like I could show you guys what we've been doing weekly. This is our gain weekly. It's about 3.42% so far. Weeks over tomorrow, so that's pretty much locked in, almost $500. And then our monthly is 10%, which is nice because obviously the gain is amazing there. Also, 3 months is 20%, which is also crazy. And year to date means from January till today, we are up literally 85%, which is crazy because I have been trying to recover this account for so long, and we're finally getting to the point of doing that. Even our yearly is crazy, 83%. Our all time is not crazy at $44 gain, but like we're just trying to hopefully get back up to our high point here when we were up almost 50%. Well, we were up actually 50%. Hey guys, for now, thanks for watching. I'll see you all tomorrow for our kick stream. Bye.